Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is May 25th, 2021. It's a Tuesday, and we've got some similarities of some history going back to 1994 we want to discuss today in our daily updates. So let's get right to it, and thanks for watching. So as I said before, if you follow along, we always talk about the 10-year Treasury. And right now the 10-year Treasury this week is settling down, and that's where we're seeing about a 3 or 4 day upswing for the markets as we know that interest rates are settling down. It's a big relationship that really dictates sort of the balance and the struggle that we see of markets trying to price in the future, which is really unknown at this moment in time. You've got so much stimulus on one side, you've got talks being happening on a new infrastructure bill or proposal, and then even tax increases may be part of that, or maybe shortly after that, and Congress is really working hard on that in terms of coming to terms. But that's where the talks are stalling right now. And then you also have just everything out there as the United States and the world is opening up. You're seeing sort of that demand meeting short supply. So you're seeing the inflation being pulled forward, obviously because you have bottlenecks here and there, but more importantly, you've got so much money in the banks for the consumer and for businesses as they open up and reopen. They want to get out there and start spending again. So all of this is making the Google search trend, the word inflation, a top. It was actually #1 last week because of all this concern. So we're watching the 10-year Treasury as it rises ahead of what even the Federal Reserve has said, which says that their interpretation of this moment in time, that inflation is transitory, which means temporary, because we're reopening. The U.S. economy is not like a light switch where you can turn it off and then turn it back on. You're going to have some struggles, fits and starts along the way, and clearly we're seeing that play out on a daily basis. Now, inflation is all around us. We're seeing it in housing, we're seeing it in commodity prices, in real estate, in stock market, in everything. So we're seeing the rise, even cryptocurrencies, right? We're seeing the rise of inflation. Everything's trying to stay ahead of ultimately what to come. So really, let's take a look at what we saw back in 1994, because we could have, history doesn't repeat itself, but it certainly does rhyme in the financial markets. If I take you back to 1994, you had the first, it was Bill Clinton was in his first term. And it was the mid of his first term, and then you had an election cycle that really flipped everything on its head. The first 2 years of Bill Clinton's, and he had control of Congress, he had control of the White House, and they did a lot of spending back then. It's almost what we're seeing from this playbook right now play out once again, but not so fast. In 1994, there was election, and then you had midterm election very specifically, and then Newt Gingrich, with a 54-seat swing from Democrats to Republican, became the Speaker of the House. That really just cut off all that Bill Clinton had the ability to do for the next 6 years, because he was reelected again. For the late 90s, that really set up very, very well for the U.S. stock markets. In fact, the S&P 500 from 95 to 99 was up on average 27% per year. If you compound that wealth, it's unbelievable. So if you were investing back in the late 90s, you understand that was an amazing time. We saw some huge acceleration and huge gains in the market back in the late 90s. Well, it really comes back to that election that really stopped everything when the balance of power was basically cut in half. And that's what the markets want to see. They saw a lot of stimulus up front back in 92 to 94. And then they said, wait a minute, there's a little bit of too much going to happen, because you can't spend it all, because you kind of have to pay it back at some point in time. At least that's what the market itself was thinking about it. But in the meantime, what was telling us that it was a little bit inflationary, the economy is going to get a little bit too hot, they were doing a little bit too much in terms of spending, was the 10-year Treasuries. We had the rise of rates. So let's go back in history. In 94, starting in January 94, the 10-year Treasury was around 3% at the time. And just a year later, in 1995, the 10-year Treasury went up 1.5 points to 5.5%. Again, literally the bond market was telling everyone too much was done in Congress and too much spending was going to happen. Therefore, there's going to be too much. It's creating too much of an inflationary sort of economy. And what happened? Well, the midterm election, the 54-seat swing sort of stopped the market's worry of overinflating or overspending. And then it really just allowed the spending that was already approved to work its way in for the next 5 or 6 years. In terms of the 90s, the late 90s. And those were the boom years. Those years, the market did exceedingly well, every index that you can think about. Are we going to repeat that? You know what? We don't know, but I will tell you right now that the Congress talks about the infrastructure bill have stalled. That's two great things that could come of this. Number one, that means a compromise has to happen back in Washington. That means that they're not going to spend as much as originally proposed, which was the fear of higher interest rates by way of what we saw this year of the 10-year Treasury. As the 10-year Treasury is backing down, it's a direct result of Congress really agreeing to disagree, is what they really do best. And so when they're not spending our money, our tax dollars, that actually is a good thing. It's okay to put some money out there, but you can't just keep spending like you don't have to pay it back. That's fiscally irresponsible, and it's very concerning long term. So markets are really, by the way of 10-year Treasury, telling a story, but we're just setting up for next year's midterm elections. It could repeat 1994. Because think about this, is the infrastructure bill, if it's not passed through as soon as they wanted to get it done before Memorial Day, that's this weekend, it's not going to happen. So then they have to resume talks after Memorial Day, which then talks about pushing tax rises, right? Tax increases, whatever happens, whatever they get passed, it's going to delay that for 2021. So it really doesn't look like they'll get a retroactive bill. And trust me, a lot of folks in Congress wanted retroactive to capture those dollars, those capital gains, those corporate spending. They wanted all of that to be done in 2021. So markets are seeing this and sort of seeing a sigh of relief by way of the 10-year Treasury coming down and way of the markets now accelerating in the last 2 or 3 trading days. So that's really the recap and the setup right now. And it's very important. In January 1994, interest rates were about 3%. In January 95, they were 5.5%, according to the Chicago economist, who basically said that the impact of interest rates, you've got to know the rate of inflation as well. And so it's interesting to see how history doesn't repeat itself, but it certainly does rhyme from time to time. So we're paying attention to that here at Blanke Schein Wealth Management. That's our interpretation of what's happening in the marketplace. Let's see if it actually plays out, and thanks for watching.